Hi, I'm James Robinson, and this is my stock pick of the week. This is my fifth and final video on the company Ruger. Today we're going to look at the wealth creation characteristics for Ruger. And the theory goes that the job of management, the overriding goal of management for a company ought to be to increase the wealth of the company's owners and their shareholders. There are a number of tools at management's disposal that they can use to do that. And those tools include buying back stock or paying dividends, paying down debt, et cetera, et cetera. We're going to go through a lot of those today and look at the job that management of Ruger has done at creating a better and better value for us, the shareholders, and hopefully increasing stock price and or paying dividends that will enrich us. Before I go any further, I tend to get behind on these videos. I tend to buy stocks when it makes sense to buy stocks, and then it takes time for me to write and shoot and edit these videos and get them published. So I'm a little bit behind. I still owe you guys a series of videos on a company called Ryanair, which I'll work on this week and next. But if you want real-time information when I buy or sell a stock, the way to find that is on my Twitter page, at Robinson Stocks. Whenever I buy or sell a stock, I will put it there. I don't always make a video, especially if it's a company that I have done a video on in the past. I might buy more shares if I think it's a good value without doing a video. I also put news and articles and videos that I find interesting on Twitter that are pertinent to what we're talking about as part of the investing. So follow me on my Twitter page if you want real information. I want to thank all of you for subscribing. I'm at about 340 subscribers now. So the page continues to grow, and I'm gratified for that. Also, if you like these videos or you make some money on some of my stock picks, then please just drop me a note in the comments to let me know where you're writing me from. Obviously, comments help with people finding the page, but also the only gratification I get out of this thing really is knowing that there's people all over the world that are following it. And so I'd love to hear about where you're from, whether it's Tennessee or Timbuktu. One of the tools that management really likes to use to increase the wealth of the shareholders is buying back shares. And they do that both for legitimate reasons and for self-serving reasons. The self-serving reason is that when they buy back shares, the number of shares outstanding decreases. And if, for example, earnings were flat, then even though the management did nothing to improve the business by virtue of the share buyback, the earnings per share would have gone up. So, for example, if they bought back 10% of the shares in the company in a given year and earnings were flat, the earnings per share would go up by 10%. When the earnings per share go up by 10%, one would expect that the price earnings would remain basically constant, and thus the earnings per share, or the stock price, would go up. And so by doing that, management lowers the bar of what it has to do to create a perception of increased value for the shareholders and makes their job easier. The flip side of that is that it does in fact do those things, and if the company actually is earning more and more money, it accelerates the earnings per share growth, which really boosts the stock price. It also is a way of enriching shareholders in a tax-free way, because the stock price is going up, but you don't have to pay taxes on that additional gain that you created in wealth. So that's sort of the two sides of share buybacks, why management prefers to do them versus dividends, and why shareholders probably play along, even if sometimes they shouldn't. So the story with this company is that it's actually done a pretty good job. Since 2006, it's gone from 27 million shares outstanding to about 17 million shares outstanding. So they bought back about a third of the shares. That's pretty nice. That means if you bought the company in 2006, you'd own a 1/3 larger stake than you used to. Having said that, they haven't actually done that many buybacks in the last 10 years. And you can see there's really only 2 times that they bought back, or 3 times they bought back shares out of the last 10 years. Now that might be justified. One of the things that should inhibit management from buying back shares is a perception that the shares are overvalued. If the shares are overvalued, then you're paying $1.10 for $1 worth of stock, and you don't like that. But generally speaking, the company would be buying back shares sort of a chunk every year. So long story short, this company has done well with stock buybacks. They've done it in big chunks, and I'm okay with what's happened. I give this company high grades for the share buybacks. Let's look at the share buybacks through a different prism. If you own 10% of Ruger stock at the end of 2009, you would have owned about 1.9 million shares. Today, through the stock repurchases, your 1.9 million shares would mean your ownership of the company has increased from 10% to 10.9%. So it's about a 9% increase in the last 10 years. your share of the company's earnings would have gone from $2.75 a share to $3.52 a share over the last 10 years. That's actually not that great. Your earnings have gone up, but they haven't gone up dramatically. This company is, again, not a company that I would say to you is a company you should buy and plan on owning for 10 or 15 years. This isn't a Buffett company with what we would call a moat and a consumer monopoly. This is more of a Graham investment where we're buying it because we think it's undervalued. When we think we've squeezed the right value out of it, we're going to sell this and move on to another company. And by the way, in addition to these earnings, you would have received a dividend, which is currently at about 3% a year. It's kind of been around that rate. So you'd have gotten that increase in earnings and you'd have gotten some dividends. Your earnings per share would have gone from $1.44 to $1.85 in 10 years. You'd like to really see that at least double in 10 years, but you did get some dividends. So that's sort of another way of looking at this for the share rebuybacks for Ruger. Another measurement for what management has managed to do at a company over a period of time is to look at what's happened to stockholders' equity. So again, to refresh your memory, stockholders' equity is the total amount of assets the company has minus the total amount of debt. Pretty simple equation. And that number for this company has really grown. In 2009, the company had just under $75 million in shareholders' equity. Today, they have about $250 million, $270 million of shareholders' equity. So it's gone up 400%. Shareholders' equity doesn't directly relate to earnings, and it doesn't directly relate to profits and their stock price, but it's sort of a leading indicator. If this company is able to continually grow its stockholders' equity, and then, as we're going to see later, they're able to get good returns on invested capital and good returns on assets, generally speaking, that company is going to perform well, but there's a lag. But generally speaking, that stock is going to perform well because management is doing good things in terms of accumulating money and doing good things in terms of getting a return on that money. Additionally, one of the benefits of buying back stock is that this amount of equity that does exist on a per share basis has gone up 9% in the last 10 years. So even if stockholders' equity had been flat for the last 10 years, it's actually gone up by 9% more because they bought back 9% of the stock. So you can see this chart looks great. The stockholder equity per share was about $4 a share in 2000, and it's about $16 a share today. So, I'm sorry, in 2008, it was about $4 a share. It's about $16 a share today. So that's a 400% increase in stockholders' equity over that period of time. And as you're going to see, the company's done a pretty good job on return on assets and return on equity over that period of time, which means that money is being utilized efficiently. Here you see the chart of return on assets. So what I'm looking for, one of the things that's really important is this concept, it takes money to make money. Your company has to have working capital. But the question is, how much working capital do they have to generate profits? And if you've got a company that needs tremendous capital, that's inefficient. You'd prefer to have that money in your pocket versus your company's pocket. So I look for companies, and it's one of the really important things for me, is I look for companies that have a return on assets of at least 10%. If it has that, I'm willing to forego looking at a lot of other things about the company because that's a really, really good sign. And you can see here, this company's done a great job. In the last year, it's dropped down a little bit, but generally speaking, it's been above 10% return on assets for a really long period of time. And as we just talked about, in addition to that, the company has virtually no debt. And so all of its assets are not costing us any interest payments. And the company's managed to quadruple the amount of assets that it has employed over the last 10 years. And so when you look at a company that's able to do those things over time, that company is probably going to do pretty well, which is one of the reasons why I don't mind buying the stock as a Graham investment, because I like the fact this company has these traits. This is a little bit is interesting. The return on shareholders' equity isn't as high as return on assets. It's actually not bad. The return on equity isn't bad. It's just that when you look at this line, this is relative to all 1,000 companies that I've analyzed. And so if a lot of the companies that I've analyzed have tons of debt, they have very, very little equity, and thus they're able to achieve really high returns on equity. This company has virtually no debt. $2 million on $1 billion company is no debt. And so relative to the wide universe of companies, it doesn't do as great a job in terms of return on equity. But as you've seen, return on assets on this company are great. And therefore, as I say in every video, I look at return on shareholders' equity, but it's not really that important to me. Again, one of the things that I think management has to do is to allocate its assets. And some of that assets can be allocated to buying back stock or paying down debt or paying dividends, which is directly beneficial to the shareholders. And some of that money can be allocated to reinvest in the business. I don't have a problem if a company reinvests money in the business. That's called retained earnings. But I want to see that that money that they're retaining is creating real value. And even better, I'd like to see them retain very little money, which means they have more and more money to give back to us, the shareholders. And you can see here, this company's retained earnings have been basically flat. In fact, they were lower for the last 10 years than they were in 2014. And avoiding that one spike, it's been basically flat. So this company's managed to increase its earnings every year and yet keep its retained earnings relatively flat. That's a really good sign that company is not wasting money on retained earnings that are not productive. This chart needs some explanation. This is an oversimplification. One of the things that I want to understand is how good a job management is doing in investing retained earnings. And the way I look at that is, if you're reinvesting money in the business in some reasonably period of time, but not necessarily 1 year, those earnings ought to generate increased income. If they're not generating increased income, then we're probably wasting that money. And so what I do is I look at how much money the company has reinvested in dividends over a 10-year period of time. And then I look at how much those earnings have increased over a 10-year period of time. And I basically come up with a ratio, which is return on retained earnings. It's a very significant oversimplification because lots of things can be happening there. But in general, I think it's a good tool just to give me sort of a foggy look at what's happening with the retained earnings. And in this company, you can see that, ignoring what happened in 2013 when it made this fantastic, it didn't really retain any earnings for a few years, and it therefore had fantastic returns on retained earnings. Generally speaking, this company's done a very, very good job of retained earnings. Last year it was very poor, but again, I think that that's a blip. I think it's going to be better next year. And that is one of the reasons why we're getting the price we're getting on the stock. But generally speaking, over a long period of time, over many, many years, this company has been able to generate very, very good returns on the very little bit of money that it's retained, which is, again, cause for excitement and a reason why I think we should buy the stock. And again, if you go back to the original video I did this on operations, you remember that the operations of this company are very, very average. And so the value that I'm seeing in this company is really in management and wealth creation, a little bit in dividends. And this is the kind of places that it's showing up. And you have to understand that you're not looking at one single category, and you can't rule a company in or out because of one category. It's sort of looking at a bunch of different things and just seeing how it all coalesces. It's like making stew. One of the things that a company can do to increase its value to the shareholders is to pay down debt. If this company had any debt and had been paying it down, I would have put that there. And that's one of the things I give high credit for. This company doesn't get any credit for that because it has no debt. But what it has done is it's managed to increase its cash position, which makes the company a safer and safer investment. It makes it better and better able to withstand things like pandemics. It also makes it better and better able to get supplies and buy new factories. This company owns $2.5 million worth of real estate free and clear, 2.5 million square feet of industrial space free and clear. But the other thing that that cash can be done is to be used to buy other companies. Lots and lots of things can happen from additional cash. And so I give a company full marks if they're able to increase their cash over time. Now, at some point, they've got too much cash and they need to be paying me back, the shareholder. But for some period of time, until some ratio, cash is a good thing. And this company's taken its cash from less than $20 million in 2015 to about $160 million today. That's a fantastic job. Again, at some point I start getting, a little envious and telling them to give me my stock, give me my money back. But for right now, I think they're doing a great job on the cash front. This chart is one of the real important charts that I look at. And what I do here is I say, what is this company doing with their profits, with their money? And there's, 5 things they can do. I kind of go over this every time. They can pay down debt. They can pay dividends. They can do a stock buyback. They can increase their cash. They can reinvest the dividends. So then I look at those things and what happened with each of those things over a period of years. And then I say, what's the cumulative wealth created over the last 5 years in each of these categories? And that really gives me a good sense of wealth creation. It allows me to look at all of the different tools that management's used and how they've used those tools and how that's generally created value for the company. And you can see that over the last 5 years, they've generated about $350 million of wealth for the shareholders. And again, this doesn't necessarily directly relate to stock price, But it's an indication that if a company's doing this year in and year out for a long period of time, we're going to do great as a shareholder. And with this company, you can see that it's just done a fantastic job since 2011. And that's one of the reasons why I'm very comfortable owning the stock. And if it takes 2 or 3 years for it to fully appreciate in value, I'm okay waiting that long, because I think good things are going to continue to happen here. The last thing that I always do on the wealth creation front is talk about the wealth creation that we might have made together if you'd bought the things I told you to buy, sort of when I told you to buy them, and sold them when I told you to sell them. And this is a current list of my portfolio, with the exception of Intel at the very top, which I sold part of my position early in the year. This is what we bought it at, how much shares we bought, the price we bought it at, our 2021 return, and return since we bought the stock if we bought it prior to that. For the year, I'm up 13.58%. I'm really doing really well versus the S&P 500, which is sort of my measure and my goal. The interesting thing is that my stocks are still very, very conservative. 10 of these companies still have a PE ratio below 20, which I think is very, very safe. I'm very happy with the results so far, especially relative to the S&P 500. And you can pause this and take some time and look at it and understand it, and look at some of the stocks we bought. Ruger, for example, is down about 1% since I bought it, but not the end of the world. And most of my stocks, only 3 of my positions are down, and some of them are up, very, very significantly this year. So that's it for Ruger, and that's it for my current positions. I'd love to hear from you in the comments, anything you think about what we've talked about with this company. Thanks.